Most people walk into a lender's office not knowing the difference between these two loans. They nod along, sign where they're told, and find out 6 months later they made a decision that costs them an extra 50 grand over the life of the loan. That stops today. This is Lesson 7 of the Property Code's free 32-lesson real estate course. We're deep in the financing section now, and this is the foundation. If you haven't done Lessons 5 and 6 on credit scores and debt-to-income ratios, go back and watch those first. This will land a lot harder once you have that base. Here's what you're going to understand by the end of this: what conventional loans are, what FHA loans are, how the costs compare on the exact same property, and how to know which one is right for where you actually are right now. Not in theory, with real numbers on a real house. Start with conventional. A conventional loan is not backed by the government. It's a private loan that follows the underwriting guidelines set by Fannie Mae and Freddie Mac, two government-sponsored enterprises that buy the majority of mortgages from lenders once they're originated. Because there's no government guarantee behind it, lenders are more selective about who they approve. They want to see solid credit. 620 is the technical minimum, but your rate doesn't get competitive until you're above 700 and meaningfully better above 740. They want a debt-to-income ratio, most commonly capped at 45%, sometimes 50% with strong compensating factors. And they have a loan limit. In 2026, the conforming loan limit for a single-family home sits around $806,500 in most counties. High-cost areas, parts of California, New York, Hawaii, go higher. Down payment on conventional can be as low as 3% through specific programs. Fannie Mae's Home Ready and Freddie Mac's Home Possible are built for lower to moderate income borrowers. Standard conventional starts at 5%. Hit 20% and something important happens. You skip mortgage insurance entirely from day one. Now the FHA loan. Backed by the Federal Housing Administration, meaning if you default, the government covers the lender's loss. That backing lets lenders approve borrowers who wouldn't qualify for conventional. FHA accepts credit scores as low as 580 with 3.5% down. Scores between 500 and 579 can still get FHA, but you need 10% down. Below 500, FHA won't approve it, and neither will most lenders. If you're sitting in that range right now, your first job is Lesson 5, not this one. The trade-off for that flexibility is mortgage insurance, and it comes in 2 layers. There's an upfront mortgage insurance premium of 1.75% of the loan amount, which is typically rolled into the loan so you don't pay it at closing. And there's an annual premium that runs between 0.45 and 1.05%, depending on your loan size, term, and down payment. For most borrowers in 2026, that annual figure lands around 0.55%. Here's the piece people miss. If your down payment is less than 10% on an FHA loan, that mortgage insurance rides with you for the entire life of the loan. You cannot cancel it. The only way out is to refinance into a conventional loan once you have enough equity. Let me show you what that looks like in actual dollars. You're buying a $320,000 home. 2 buyers, same house, 2 different paths. Buyer A goes FHA. She has a 620 credit score and has saved $15,000. She puts 3.5% down. That's $11,200. Her starting loan balance is $308,800. The upfront MIP of 1.75% adds $5,404, which gets rolled in, bringing her financed amount to about $314,200. At 7%, a realistic FHA rate in 2026 for a 620 score, her principal and interest payment is roughly $2,091 per month. Her annual MIP at 0.55% divided by 12 adds another $144 a month. She's all in at around $2,235 before property taxes and homeowners insurance. And that $144 runs for 30 years unless she refinances out. Buyer B goes conventional. He has a 700 credit score and $20,000 saved. He puts 5% down, $16,000. Loan amount is $304,000. At 6.75%, he earns a better rate because of his credit score. His principal and interest is $1,971 a month. He's paying PMI at around 0.7% annually, which adds $177 a month. He's all in at $2,148 per month. But when he hits 20% equity, through paydown, appreciation, or both, that $177 disappears automatically. Federal law requires servicers to cancel PMI once you reach 78% loan-to-value on your original purchase price. He doesn't have to refinance, he just waits. Same house. Buyer A is paying $87 more a month with insurance that never leaves. Buyer B's PMI could vanish inside of 7 years depending on how that market moves. Over a 30-year loan, the difference in what they each pay for mortgage insurance alone runs into the tens of thousands of dollars. That's money that could have been a down payment on a second property. Now let me tell you when FHA actually wins, because it's not always the worst deal. If your credit score is below 680, FHA rates are often competitive with, or better than, conventional rates. Here's why. Conventional loans have what are called loan level price adjustments, or LLPAs. These are add-ons to your rate or closing costs that lenders charge based on credit score and down payment. A 640 score with 5% down on a conventional loan can see rate add-ons that push your cost well above what FHA would charge for the same file. When you factor that in, conventional stops looking clean. FHA also wins when your debt-to-income ratio is high. Conventional lenders get uncomfortable above 43 to 45% DTI. FHA will stretch to 56 or 57% in some cases when you have compensating factors, cash reserves, long, stable employment, that kind of thing. And FHA has one more use that experienced investors know about: house hacking. If you're buying a 2 to 4 unit property and you plan to live in one of the units, FHA allows it. You bring 3.5% down on a fourplex, collect 3 rents, and let your tenants cover your mortgage while you build equity. That's a real strategy. The FHA loan limit on a 4-unit property in a standard cost area in 2026 is around $1.55 million. You have significant room to work with that. When does conventional win outright? When your credit is above 700, you can get within range of 10 to 20% down, and you're thinking past this first purchase. Conventional loans can be used on investment properties. FHA requires owner occupancy. You have to live in the home, and you can only carry one FHA loan at a time. As you build a real estate portfolio, you'll graduate out of FHA territory eventually. The investors who know that plan for it from the beginning. Here's a tool. The Consumer Financial Protection Bureau runs a free mortgage calculator at consumerfinance.gov that lets you model both loan types side by side, including PMI and MIP. Use it before you ever sit down with a lender. Run both scenarios on whatever property you're looking at. Know your numbers before anyone tries to sell you on theirs. Loan officers are not your financial advisors. Some are excellent. Most are paid on commission. The best thing you can bring to that conversation is already having done the math. Before Lesson 8, do this one thing. Pull your current credit score. Credit Karma gives you a working estimate for free, but for anything real, use annualcreditreport.com to get your full report from all 3 bureaus. Write down 3 numbers: your score, your total monthly debt payments, and your gross monthly income before taxes. Divide the first by the second. That's your DTI. That single number tells you what loan category you'd qualify for right now, and it tells you exactly what to fix if the answer isn't where you need it to be. Lesson 8 goes deeper into the approval process itself, what underwriters are actually looking at when they review your file, and why two borrowers with identical scores can get completely different answers from the same lender. The code doesn't expire, but your window might.